Hey everybody, welcome to our third webinar, Planning for Growth. So we're super excited that you're back with us today. We hope to change the format a little bit today into a question and answer session, so it's a little bit more interactive and less about presenting slide after slide. So with this, we're going to start into our first set of questions.
Is growth always a good thing?
Yes and no. And growth can be a double-edged sword, frankly. Growth, when you've planned for it, can be a wonderful thing. And everybody wants to grow, obviously. The reverse of growth is decline, which nobody really wants to do. But growth unexpected or growth at the wrong time can be very damaging because you can be underprepared for the growth and therefore your quality can suffer. You can be underfunded for the growth so that you don't have the right people in place. So growth isn't always the best thing, but planning for growth is.
How can I plan for growth?
So how do you plan for growth? Well, when you plan for growth, you start to think about what are the key aspects of my business that are important to grow. Well, there's a couple. First is demand. Why do my customers show up? What is special about me? What do they like about me? Understanding those fundamentals and understanding what drives them, so you understand how your demand is created. Is it created from advertising? Is it created by word of mouth? Is it created by who knows? The second step is understanding your cost structure. So how much does it cost to service my demand? If I had an increase in demand, and how much capacity do I have to service this demand? What would it take to have the right capacity to service this demand? Do I start to hit diminishing returns? Does it become more expensive to service the next customer than it was to service the prior customer? That can happen if you have to shift from, say, your workers are regular hours, and now because you've had so much extra capacity, you have to go to overtime. The third area to really consider when you're looking at growth is profit and cash flow. This depends on how you serve it, how you turn cash into, you turn a sale into revenue. So for example, if you have a lot of outstanding bills and you do a lot of invoicing, the fact that you've grown a lot means that you have a lot of accounts receivable that could be sitting there aging, that you run out of cash to pay for your regular bills. All that new growth is sitting in a place where you just can't use it.
What questions do I need to ask myself before growing?
Well, we'll go back to the three areas that you have to consider. So first is, do I have a good handle on my demand? Do I know how I create it and what drives it? Second, do I have a good handle on my expenses, both direct and indirect? So do I have a good handle on my indirect expenses, which is my overheads, do I have to have store hours longer? Do I need more space? So on and so forth. And as much as what your variable costs, which is usually labor and materials. So understanding, do you have a good handle on that? And then third is, what's your cash position? Can you handle that growth? Is that growth being funded in such a way that, let's say, it's a net 60 days and you're paying on a net 30, you've had to increase your capacity to service this extra growth, but you need to pay them in 30 days, but you don't get paid till 30 days later.
Is my company going to be ready for me to take on a bigger job?
Well, that's a great question, because you have to ask yourself, do you have the bandwidth to expand? That's one of the key things when you start to talk about people. You're one person and you have to think about that. So when you look at your daily activities and you think about what expansion would mean, we have a great tool that I think you should take a look at in our tools and tips, which talks about how to look at delegation and what are the right things to delegate. Once you've gone through that exercise, you can see how much extra time you've created for yourself by delegating, and therefore you can determine whether you have time to do a bigger role, or if you need to hire someone to pick up some of your old roles so that you can expand into a bigger role.
How do I know if I have the right employees for growth?
That's another great question. So the right employees for growth goes back again to that delegation exercise that you'd be going through and saying, looking at, all right, if I bring in this that if I bring in more demand in these different places, where are the gaps in my organization? Then when you look at those gaps, it's what skills do I need for to fill those gaps? Once you know the gaps, the skills, you've now written pretty much a job description. Once you have that job description out, it's easy to recruit to those specifications. And it's really important, especially in service, to make sure that your employees fit with your brand. And therefore, when you go through that interviewing process, you also not only are interviewing for the skills, but you're interviewing for the fit.
If I'm going to open another location, where should I be placing it?
That's another great question. If you are looking at expanding locations, the most important thing is to ensure that the next location you go to looks very similar to the same location where you were successful. So what do I mean by that? Well, that means, do I have the same demographics? So age, do I have the same income? Is it the same education level? Is it the same commute distance from people's offices or work, or is it longer? What you want to do is try to find a second location that looks very similar to the one where you were successful, because that increases your chances of being successful in the new location.
How do I make sure that customers keep showing up?
Well, that's another great question, especially when you expand, because you're going to be split a little bit. You as the owner, to ensure that your customers still show up is not to lose focus on making sure that somebody is in charge of controlling demand in your current location while you put some of your focus on the new location. If you've done it well and the demographics are the same, you can use a lot of the marketing materials that worked in the one location should be replicable in the second location.
How can I grow so that it doesn't bankrupt me?
Well, first, it's important to understand what's it going to cost for you to grow, right? So we'll go back to our three things, which is demand, expenses, and cash flow. So having a good handle on all of those three in your current state can help you project what you need to grow in the future state. So it's really important to have a plan of what your growth is going to look like. And then it's also equally important to be able to itemize the cost that you think that is going to take to get to that next level.
Should I be looking to fund my growth internally, or should I be seeking capital?
Personally, I think you should go and seek capital, especially if you have your plan and you have the costs detailed down and it's very clear what you need. Seeking capital gives you a cushion in case any of those things are off somewhat. It doesn't put any additional stress or strain on your current business. Now, the risk of going after capital is that you have to feel that you can grow faster than the interest rate on that capital. And that is something that you need to consider when looking at which capital to choose.
What are the different ways to get capital?
Well, there are many. One that everybody loves and should always try to get is an SBA loan. They have the best rates and the best terms, meaning 7 to 10 years, only a couple points above prime. They're generally the best thing you can get as a small business. Now, they come with strings attached. You have to have a very good credit score, you have to be in business for 2 years. It's a lengthy process, so it's not something that's quick. The other alternative is to have a bank loan, a commercial bank loan, usually has a shorter term, higher interest, but again, very reputable, very manageable. Interest rates aren't that bad as compared to what you would get on an SBA. Again, comes with strings attached. Got to have great credit, and at least in business for a year. Alternative ways of getting capital, and this is where it starts to be, you have to weigh the risks, the pros versus the cons. There are alternative lenders, and there are a multitude of them. And we could spend a whole webinar on that, which we'll probably do sometime in the future. However, for right now, let's just suffice it to say that these alternative lenders are more expensive because they are willing to take on what we'll consider a riskier client, someone with less than perfect credit score. And they tend to have, middling, same type of terms as a bank loan, 4 to 5 years, but interest rates that are significantly higher. The final way is really getting into the merchant cash advance or some of those very high interest rate alternatives. And if you have to go there to grow, you probably question whether you're ready to grow.
What happens if I grow too soon?
Well, there's a couple things that can happen, and you'll know them right away. If you grow too soon before you have a really good handle on your demand, customers aren't going to show up. So you're not going to meet your forecast, and you should know very quickly that you need to course correct in order to fix that. If you grow too soon before demand by hiring employees before you're ready or before the demand hits that you need those employees, you're going to be carrying that overhead, and that's going to cause a drain on your cash flow. The final thing is if you grow too soon and get a location that isn't quite right, or you've made some compromises, that can put you into some trouble, again, going back to lack of demand or an excess overhead.
What if I can't grow in the near future?
Okay, let's say you're not in a place where you can get the capital to grow, nor do you have the funds available to fund your growth internally. The best thing for you to do is improve your financial position. Okay, so how do you improve your financial position? Well, there's a couple ways. One is figuring out how you can make more profit per sale. So if you can't grow in number of people, is there a way that you can grow in number of products that they buy at the time that they're in your space? Can you trade them up? Can you add things to it? The other thing is, can you become more efficient? So can you look to reduce expenses, whether it's from employee expenses, material expenses, whatever expenses may be, to slim down your growth and make your financials look a little bit better. Finally, if you're struggling to get capital, it's likely that your own personal credit isn't where it needs to be. And so again, by trying to get more revenue from the customers that you have, trying to get more efficiency out of the processes that you have, may enable yourself to earn a little bit more that can then help you get yourself into a better credit position.
Do I ever stop growing?
Well, that's as individual as each person. Everyone has a limit to which they're willing to go. But however, in most cases, no, you don't ever stop growing, or the desire to stop growing. And it's always a good idea to continue to plan for growth, even if your planning for growth means your exit from the company. So if you've come to a point that you've reached the pinnacle of where you personally want to grow, maybe it's time that you think about how you can get the business to continue to grow while you exit. All right, everyone. Well, thank you for joining us for our third webinar. Stay tuned next month. We'll be talking about how to write an elevator pitch in less than 10 minutes. That should be a very interesting conversation, because it's always great to figure out how you can talk about your great ideas in a very succinct manner. Also this month, we will continue to post topics on growth, readiness for growth, and any other information that might be relevant to that. So again, thanks for listening. See you next month.